So good evening everyone. My name is Ming. So I'm a financial trainer analyst of uSMART. For the past 7 years, I've been a full-time trader. I trade forex, stocks, cryptocurrency markets, and also use automated trading strategies like trading to get a relative consistent profits in the markets. So recently, I've just joined this education field, and I hope I can share my experience to you all, especially for the beginners. So today my topic will be the recap of basic option strategies. So for the past few weeks, actually I had shared about how to become a profitable trader and how to do technical analysis and the basics of the options trading strategy. So today I will do a recap again, and I hope for those new joiners can learn something from here. So before I start, I hope that you all can stop me, ask any questions. Don't be shy. I hope you all really learn something here. Alright, so now I will start my presentations. Okay. Sorry. So first of all, I will explain you again what is options. So options is actually a trading tools that can magnify your returns and returns can magnify your returns. Means like it's something you can use like to leverage your entry, to leverage your returns. But at the same time, it also leverage your risk. So we need to know how to use it well, and we need to know how to do the risk management too. And options allow us to trade in any kind of market conditions, whether it's uptrends like very bull markets, downtrends, very bad markets, bear markets, or even sideways. We also can benefit by using option trading, even though when the market is on sideways. So there's different kinds of option trading strategies, but today I will just share with you all those basics one. So options can be used in a very bullish market or very bearish markets. Sometimes for the slightly bearish one, we also got a actually more advanced strategies to tackle it. And also sideways market, we use sell covered calls or maybe cash secure puts. I will explain it later. So it's actually very versatile trading strategies, trading tools. So I hope you all maybe can learn something. So learn these options, because like you can tackle any kind of markets. Imagine that if now is a bull market, you usually can earn the price from low to high, right? But how about when there's a heavy corrections or the market is on sideways? Can you make any profits? So based on those kind of situations like sideways or downtrends, we actually got these options to help us to amplify our returns instead of we waiting for the next bull market to come, right? So it's very important to know these options, as is one of the leverage trading tools. Leverage means that it can magnify your returns with a small amount of money, because many places don't have CFD like contract of difference that can use leverage. So for those countries that cannot trade CFD, option is always the best strategy, best trading tools to use to leverage your returns and risk. No, leverage your returns. Yeah, at the same time, the risk you need to know how to control. Okay, so this the basic understanding about what is option. So Option usually talk about these two things, the right and the obligations. Remember, the buyers always have the right. In the options, there are two buyers, which is call buyers and also put buyers. So call buyers and put buyers are buyers. They have the right. You all must remember, for in options, the buyers always have the right. So what is right? So is right is something that when the option is expired, the buyers can decide to buy or not. So it has the right to buy or not. Whereas for the put buyers, it has the right to sell or not. And the buyers always have the limited risk. So I just roughly explain back what is call buyer and what is put buyers. So if you want to buy a stock and you foresee it to goes up, so we usually use call options. You buy call options. Then when we want to short the stocks, we want to profit from the stock price fall, we buy put options. So for call buyers and put buyers, always remember that they always have limited risk. So what is meant by limited risk? Limited risk, it means by you only pay the premium. So when we as a buyer, we buy the options, either call or put options, we need to pay the premium to the seller. And the premium is our maximum loss. Maximum risk is our maximum risk. We at most lost this premium only. So these options, one contract is 100 shares. So it's like when the premium is maybe $1, so we need to at least pay 100 to the seller, because one contract equals to 100 shares. At least one contract need to have 100 shares. So the maximum we lost, the things we lost is the premium only. So when there is a buyers, there will be sellers, and sellers have the obligations. What is meant by obligations? So the call sellers are obliged to sell. The call sellers are obliged to sell means that the call sellers cannot decide to sell or not. When the call buyers want to exercise their rights to buy, the call sellers have to sell. They cannot say no. And when the put buyers have the right to sell, the put sellers are obliged to buy. Means the put seller cannot say no when the put buyers have the wanted to exercise the right to sell their options. So there are two parts of people in options: buyers, sellers. Buyers always have the right, and sellers always have the obligations. And buyers always face limited risk, which is they lost maximum premium only, whereas for sellers, they have unlimited risk. It means if you all don't know why you will face unlimited risk, maybe you all can look back to my field replay a few weeks ago. So for this unlimited risk, you just remember sellers always have face unlimited risk, and their maximum profits will be the premium collected from the buyers. So the buyer's maximum loss is the seller's maximum profit. So just remember this basic stuff, and yeah, and this is all the recap for what is options. If you all have any questions, you all can just leave down, or maybe too fast, and you all can let me know. So don't be shy, yeah. So today I am sharing about the basic options trading strategies. So for past few weeks, I've been sharing these basic long call. So what did we do, and what do I do when I long a call? So when to deploy this long call? It means when we are buying a long call, we are doing a long call, we want the price to goes up in orders to profits in options. So we must look at the either price chart or either fundamental reasons very bullish, and we expect the price to move very sharply, and there's a low implied volatility IV less than 50%. For those who don't understand what is implied volatility IV, is actually the extrinsic value of the premium. Okay, premium is made out of intrinsic value and extrinsic value. So here for low IV, you all just remember I usually choose less than 50% or even 40% IV to trade. Why? Because I don't want the stocks become too, when there's high IV, usually the stock is very on hot demand. I don't want to chase the stocks when the price is very volatile or very keep up and down, very volatile, many people chase very hot. I usually wait for the stocks to settle down, and then I will buy it. So it depends on you. It is not that you cannot trade the IV above 50%, because sometimes the very hot stocks, the IV is indeed very high. So this is just my preference. In trading strategies, we need to find out what suits us the most. I just give this as a guideline. And when we want to buy options, we want to find an entry with the high risk, high reward. I mean, there is no low risk, high reward. So we want to find those with high reward, because our maximum risk is actually, there won't be have high risk, because if we control the risk, because our maximum, remember, our maximum risk will be our only premium we bought, and the maximum loss will be the premium only. So we want to find a stocks that can probably have a good chart patterns that can goes up very high. So you want to find those trade setup. And yeah, lastly, I will use the technical patterns like the chart patterns, and any kind of technical chart, famous chart patterns, you all can consider to use it as an entry. And I also observe if there is enough momentum. Usually when enough momentum, it means always at the top gainers, and the volume is very active, and I usually put that in the watch list, and I won't buy it when it's hot. I will wait it maybe a few days later or maybe 1 week later when the price drops to a certain support, and I will do an entry there. So I won't buy when there is many people chase, when many people goes in, because and when the price is very high, like shoot up very fast. So I will always patiently wait for the price to come down. Remember, in trading, we don't chase the stock. We wait for the price, the stock price to reach. We wait at the stock price, certain stock price, and then we wait it to come to us. We don't chase them, because when we chase the stocks, it's actually very dangerous. And my famous one is in the technical analysis, I will use it to when the price breaking out from consolidation, and also price bouncing off support on an uptrend. So first we need to know whether the stock is on uptrend. Then we want to we need to decide our risk reward. Then we choose those with low IV and those with high momentum recently, and enter based on the whatever technical reasons you see. So for common one, we will be using MA strategies to determine the trend. So what is MA strategy? MA strategies actually is a moving average strategy. It is the average of the closing price of each day. Like maybe MA14 is the closing price of the stocks for past 14 days, is the average. So when the average is getting higher and higher in the like moving average 14, like in 40 days, it means that in these 2 weeks the price is getting higher and higher when the candlestick is above this line. So we want to choose those MA lines above, like here is like, sorry, here the line MA line is 40, is 20, 50, 100s and 200s. So we want the 20 above 50 and then 50 above 100s and 100s line above 200s. So and then we long at a certain support, whether you decide to enter at 50 or 20. We need to wait it drops, hit a certain moving average and form a bullish bar. Then we enter the long. And the basic one, and for me, I like to use support and resistance very much. Sometimes I even use naked chart only. It means I only see those support and resistance. Right. So here we can see what is support and resistance. Resistance actually is when the price keep hit a certain high and it keep reject from it. When it hit many times, it will form some kinds of resistance there. Then when the resistance is breakout, is breakthrough, the stock price breakthrough the resistance, you can say that the stocks is breakout. And usually I won't chase on breakout. I will wait it to drop back to test previous resistance. So if the previous resistance become a support, like it hit the previous resistance and then it form a certain bullish signal, bullish candle bar, so I will enter it. I will consider to open the long position here since I want to buy a support, buy a long. So for long strategies, we usually buy when it's bounce off of the support. So you can just actually trade along supports and resistance, support and resistance. So we just plot the swing high and swing low and those areas that a lot of like resistance or support when the markets get reject off or bounce off. Alright, so this is basically how I do entry long call. So we just choose one or two technical analysis, technical tools or technical strategies, then we practice it until we are very familiar with it. Because there are a lot of people, they learn a lot of technical strategies like maybe RSI, MACD, all those supply and resistance, the supply demands, break of structures. There's a lot of technical strategies, but as an experienced trader, I think we just stick down to a easiest one to understand, and we make the strategies very easy to understand and execute for a long time, for a long run. Because when there's too many strategies, first it's very hard to weigh all the checklists, the criteria to hit. So like if for me, I like to use support and resistance and liquidity grab, and so these are certain advanced stuff, but I usually use support resistance. So I try to buy at the supports and I try to sell at the resistance. I wait the price to come down. I just plot and wait the price. I won't chase in between those swing high and swing low. I will always plot the low, the support, the obvious strong support and the obvious strong resistance, and I will wait the price to enter there. But first, I will pick the uptrend stocks, right? For how to pick uptrend stocks, I actually had a sharing sessions. I think in Thursday. So you make sure you all, if got time, can come and check out. how I filter those uptrend stocks and how I pick them. Alright, this is a small preview here. So yeah, this is how I do a long call strategy here, and I hope you all can use this as a reference. I just use support and resistance. Break out of the resistance, then drop all the way back to the previous resistance, then tested whether it becomes support or not. Then I do an entry. Oh, it's just simple. It's just simple like that. But you need to always back test, so you all have the confidence to enter the market. Even though I said, oh, this is very easy, but in fact, it's not that easy. You need to have practice a lot. You need to look back a lot. Then you know when you see these patterns, how you control your risk, and what's your expectations, what is your plan when the market's up or down. So all these trading plan, remember, you all need to all practice and trade by yourself to understand all this. Theory is just a theory. Without practical is meaningless in trading. So next is the opposite of what I shared just now, which is long puts. So when do we open a long put? Yeah, first, when we look at the market, it is very bearish, whether it's fundamentals or technicals. Then we expect the price to move sharply, drops. We expect the price to drop a lot. Then we will choose the low IV one, because we don't want sorry. So we don't want the IV, we don't want the market, we don't want to short the market when the market is like pumping a lot, like very hot, like many people chase. We want to short it when it's relatively stable. So we chose IV less than 40%. Yeah, the high risk, high reward, I want to choose those. I will try to sell a put long a put when I foreseen the markets will drop a lot, or I am afraid the market will drop big anytime. Then for optimal technical patterns, for technical, I will look for the optical technical patterns. I got high momentum one, the price breaking down from the consolidations, and price rejects from the strong resistance. So for looking at the big trends, we are looking at this MA to filter out the big trends, to see the trend. So it's the opposite of just now what I shared in long call. So now the trends will be, we want to try to short a stock when the MA 200 is at the top, and then 150 and 20 at the below, and the stock price, the candle is all below this moving average. So for EMA, it's actually an exponential moving average, is more sensitive, slightly more sensitive than this moving average. Is almost the same. So in this case, this is an example of Pfizer. So Pfizer have been a downtrend for a very long time. So these stocks is not advisable to do a long. We need to avoid at all costs, especially the stocks is below EMA 200. Why? Because EMA 200 is a long-term downtrend line. The stocks for the past 200 days is not good, it's trending down for such a long period. So we need to avoid all this. We need to avoid to buy, not avoid these stocks, avoid to buy a long in these stocks, right? If not, you will buy, it will get lower and lower. In trading, we need to follow the trend. So trend is our friends. We don't counter it. No matter how good the fundamental is, sometimes the fundamental can be very good, but then the technicals is very bad. So we need to look at the chart patterns. So we don't try to buy the stocks when it's a long-term downtrend, because long-term can take years, or even maybe at the end something bad happens, then it's too late already, you cannot get out. So we try to buy a good stocks, quality stocks, and strong business stocks in order to have a better win rate in the markets. Yeah, so you can see this is MA strategies. The Pfizer keeps drops. Then the MA in the lower time frame like 20, 50, 100 try to switch up, but in the end there's MA 200 is still act as a resistance, and then it's consolidated a bit, then it drops back a bit. So this is the area we can consider to short, because it goes up, it consolidated, it tested the resistance, and then it broke down. So Pfizer in this case as example is a good stock to look for shorts. So this is how we use these MA strategies to looking for a short downtrend stocks, to look a short to open long puts. So here is the support and resistance. So we can see there's a lot of support resistance in the markets. Sometimes I don't trade those very like internal structures of the market. I always look at the biggest one, the very swing low and the swing high. I observe all those places only. But we can also trade those. If you are very experienced traders, you all can trade such a small movement. So this is just an example for you all can see that support can become resistance and resistance can become support. So if you all know how to draw this, when there's many areas that get rejected and there's a support area, the swing high swing low basically is also support resistance. For recognize this support and resistance first, then we decide to enter long or short based on the based on the trends. Okay, in this case is Nvidia. I think the price action is a few weeks ago. You can see that there's a support resistance, and then it breaks out, and then it tests back, become a resistance again, or become support, because we still the very right one, at the right one, it still don't have any significance entry yet, significant signal yet, because it's just a red bar. We need to wait there's a bullish bar to comes out in maybe 1 or 2 days or 3 days. Then we can by that time, with the confirmations, we can do a long call to goes up. So it really depends, because it can be it drops, it break through previous resistance and then retest the previous resistance to become a resistance again. Then we can try to long a put. So these are examples of one of the examples of a stocks called Qualcomm. I think this chart is few weeks ago when I made this, and you can see this swing low and swing high, and there's many supports there. There you can see there are 2 or 3 touch support below, and this is the area I will monitor. So in between I won't monitor. You can monitor for those who favor short-term one. For me, I'm looking on a big time frame. So this is the area I will look at. And for the right side, let's say at that time when it hit open high, close low, then another days it drops, it closed with the red bearish engulfing bar. So I will consider to take a short, to take long a put, to buy a put options, because when we buy a put options, we will earn profits when the price drop. So this is the area I will consider. Then the targets will be the next supports. Remember, when in big time frames, the market price usually will bounce off between major support and resistance, major support and resistance. So you all can monitor and backtest this in your maybe chart, and then slowly will have a better understanding of what I say. Support resistance, just focus on this basic trading strategy. Then you will find out that then you will eliminate many noises like trading strategies. You don't have to look at a lot of stuff. You just monitor support resistance. Normally the support and resistance, the price will move from daily support to the daily resistance, weekly support to weekly resistance. So it depends on which time frame you want to use. And yes, it involves a lot of patience, understandings, and confidence about how you know your strategy well. Okay. So I just make a recap again about what is call options. Here you can see that in call options there is call buyer and also call seller. And call buyer, they will pay the premium to the call seller, and the call seller will deliver, and the call buyers have the right to buy or not, and the call seller is obligated to sell the stocks from the call buyer based on the strike price. And the call buyer want the price to go up, and the call sellers want the stock price to go sideways or even go down. So just now we are talking about the role to become a buyer, which is call buyer, and also when the price you expect is going to move up, when the stock price is uptrend, and call seller, no, not call seller, and the put buyer. Put buyer is when you want the price to drop, then you pay the premium to the call seller, and the call seller will buy. So next, I will talk about we change the role from call buyer and put buyer just now to become a call seller. So call buyer and put buyer, we pay the premium, right? And now as we become the call seller, we receive the premium. It means our maximum profit will be premium. We just want to earn the premium from the call buyer. So remember this, call buyer have the right to buy the stocks from the call seller, and call seller is obligated to sell the stocks. So you can see, to sell the stocks, what it means by, if you become sellers, you have to sell your stocks. You can see it as you wanted to take profits because you want to sell the stocks. You own the stocks and you want to sell the stocks. So you can become a call seller when you sell the stocks. You wanted to sell the stock at certain price. So let me go further explain in next, which is strategy 3, selling covered calls. Just now, strategy 1 is long call, strategy 2 is long put, then strategy 3 will be the selling covered calls. We become the call seller. We exchange the role from buyer to the seller. So what is the purpose of doing sell covered calls? First, to generate additional income from your stock investment portfolio. Then we can, at the same time, we can get the capital gains, dividends, and also options premium. And this is a very high, and this is a higher returns on investment. So before I go into this covered calls, sell covered calls, let me explain sell naked call. So sell naked calls, basically we are selling options without owning the stocks, and we collect a premium. So whenever you become a seller, remember, we as a seller, we will direct earn the premium first, because the buyers will pay the premium to us. So we will collect the premium when the contract is due. And when the stock price rises for the short seller, for the call seller, we don't want the price to go up, because the buyer wants the price to go up. We don't want it to go up so that we can earn their premium. So the stock price rises above the strike price, and you must buy the shares at the market price to fulfill your obligations, potentially incurring significant losses. It's because when you become a seller, your return is unlimited because you don't own any shares, so you have to buy the share at the market price to fulfill your when the price goes up, you have to buy the shares at the market price to fulfill your obligations. What is our obligations? Obligated to sell the stocks from the call buyer at strike price. Okay, so covered calls. Because we are selling, if we become a call sellers, we need to sell our stocks. So what is, just now we explained covered calls. Covered calls is you own a share of stocks. Just now a naked calls, you don't own the stocks on hand. So if you own a stocks on hand, then it's not dangerous for you because you own a stocks. Then when the price goes up, you will just take profits only, sell your stocks. But if you don't have the stocks, you do a naked, you incur a very big loss because you don't own the stocks. You have to sell it at a very high price. So when you do a covered calls, you agree to sell them at the strike price. Then you collect premium. I will give an example. You own a shares of ABC at $50 per share. Then you sell a call options with a 55 strike price, expiring in 1 month, and earn a 2 premium per share. So imagine you earn a $50 share, then you wanted to sell it at $55. You can, instead of waiting it to hit $55, you are initially planned to sell at 55. So while waiting it to hit TP, you can sell it at 55 strike price. We can sell the call at 55 strike price. Then you earn the $2 share per share, premium per share. So if it didn't hit, you will get the $2 premium, and then you sell again the call at 55 until it hit until it hits the TP, which the strike price, which is 55. So if it hit the 55 strike price, you are obligated to sell to the call buyer. So you'll just take your stocks and sell it at 55. Then you earn the $5, 50 to 55, $5 capital gains, and the 2 premium per share. So on the other way round, if the stock stays below $55, because you open the strike price at 55, you wish to take profits at 55. Call sellers is obligated to sell the stocks to the buyer. So if the stock stays below 55, it never hits 55, you will keep shares. You keep your own shares because you didn't have to sell your shares, and you will get the premium. So if it keeps staying above 55, we will keep on sell until we hit our profits. So you can earn while waiting your price to hit a certain profit, certain TP. So in covered calls, actually is a win-win situation and has a very high win rate, which many big players like to play. So to recap, if the stock rises above $55, the buyer exercises the options and you sell the shares at $55, keeping the premium but missing out on gains above $55. Because we bought these stocks at $50 and then you wish to sell it at $55. So the downside is when it hit $55, you have to sell your stocks and get the premium and then move on. So if the stock continue to goes over 56, 57, you lose the capital gain. But you can never time the markets. So this is how we maximize our profits while waiting to hit the TP. So we use this covered calls. Remember, covered calls, we need to have stocks on hand. Alright. So to make a summary, why use covered calls is because you can generate additional income from stocks we already own. Imagine if you are with sometimes the stocks like sideways for a very long time, right? It's sideways for a very long time and then it didn't hit your TP. Then when you sell this call, you keep on generating the premium, you keep on sell maybe every month the option expired. And then if the stocks got dividends, you also get the dividends, you get this premium gain until you hit your TP. So this is a win-win situation. It reduces the effective cost of holding stocks because it generates extra income and generate extra passive income. And it's suitable for stocks and you believe that will remain stable or grow slightly. Like sometimes like maybe some stocks like insurance stocks, they can be like up very slow or maybe sideways for a long time. So you all can consider to use this, or sometimes your targets when you just do a long on the stocks, you all just can consider to open this sell call. Alright, until now I have covered 3 strategies I have shared for the past few weeks, and this is considered quite a quick run through, and I hope you all got an idea on what is covered calls, what is long put, what is long call, and later another one will be a cash secure puts. So until now, any questions? All right. So I think not much questions from y'all, and okay, I will continue. Next, I will talk about we become a seller side of put options. Obligated from here, put buyers, when you look at you want the stocks, you want to profits from the stock price to fall, you become buyer of the put. Then if you want to receive a premium, you don't want the price to you want the price to go sideways or goes up, you can consider to become the put seller, which is the writer, to earn the premium from the put buyer. And the put seller is obligated to buy the stocks from the put buyer at strike price. So what it means by buy the stock means you are putting a buy limit. You are waiting the stocks to hit certain price and then you need to buy the stock. So how can we benefit from this by become a put seller? So next, strategy 4, cash secure puts. So it's an option strategy where an investor sells a put options and set aside the cash needed to purchase the underlying stocks if assigned. It's like when it didn't hit the stock price, you don't have to buy the stocks, and then you keep earn the premium. However, if it hit the strike price, you need to prepare a cash to buy the stocks. So actually it needs quite a lot of money. For beginners it's not so friendly because at least you need to buy 100 shares, but we still can learn it in futures, maybe just a very high win rate, but maybe need a little bit of bigger capitals to do this cash secure puts. Then we can keep on generate the income while potentially buy a stocks at a discount price. Because let's say the price is now maybe at 100, we want to buy at 90, so we can sell a put at 90. If it didn't drop to 90, we can keep on get the premium. If not, if we hit 90, we need to prepare our cash to buy it. If we don't have the cash to buy it, we will suffer a big loss, and yeah, the broker won't able to let you open the sell when you don't have enough cash. So step 1, you choose a stock and the strike price below the current market price. Then you sell a put options and collect the premium. Step 3, you set aside enough cash to buy back the stock at the strike price if assigned. So possible outcomes: when the options becomes expired, worthless, you keep the premium. Then when the option is assigned, exercised, you buy the stocks. I mean, when it drops below the strike price, you can buy it at a cheaper price because you get the premium at the same time. So total, you get a cheaper price. Let's give an example. For stock price, current price is $50 and the strike price is $45. The premium is $2 per share. The contract size is 100 shares. For scenario 1, the stock price expiration is $48. So options expired worthless. Expired worthless means as a put sellers will gain the premium. So all the premium, the profits, $2 per share times 100 is $200. So when the options expire worthless, we'll keep on get the premium until it hits below this strike price. So we have to exercise the options. We have to use our cash to buy the stocks at $40. But remember, our strike price is 45. So minus 2 premium, we actually use $43 to buy. Because the stock price expired at $40, we need to buy it at 45. Because even though now it is $40, but we intended to buy it at 45. But remember, we have already received the $2 premium. Let's say now the $2 premium is 45 minus 2 is $43. So basically we are using $43 to buy the stocks. Imagine that if the price didn't go below this and it maybe go through like 1 year also didn't drop below this, and then every month we collect this premium, we actually can get much more discounted price at lower price to get the stocks. Alright, so this is how we use cash secure puts. Remember, cash secure puts, sell puts, is we use as a buy limit. You want to buy the stocks while waiting, you want to earn the premium. And for the sell covered cost, we want to earn premium while waiting to hit TP. One is hit premium. One is earn premium waiting to hit TP, and one is earn premium waiting to buy the stocks. The benefit is more or less the same as the sell cover cost, which is generate incomes from premiums and the opportunity to buy quality stocks at a discount. And yeah, because we keep receive the premium, so we get a lower cost basis compared to direct purchase the stocks. The risk, the limited profits potential is kept, but because our plan is want to buy at a certain price, and it requires significant capital to secure the trade. Yes, because you need to prepare a lot of cash, because at least 100 shares you need to buy. Alright, so next will be a very fast go through about this uSMART app. So how do we use options? So first, you'll just choose whatever stocks you want, then you choose those option tab, you press in, then you'll see a lot of first ask first bid informations, then got call or put, depends on what you want to do, and then there's expiry dates. You can choose different kinds of expiry dates. I advise more than 1 month if you want to do an option trade. Then there's the formation of first ask or first bid, the price you want to take, the strike price, and yeah, and other informations like open interest, implied volatility, and a lot more. But I just focus on this few. I will focus on the implied volatility here. And then if you decide one of the options, in this case is a put, you press trade and then buy sell. For the buy sell is for the long, for the buyers part. And if you want to sell call or sell puts, you need to press the short selling. And buy sell, if you want to close the order, you also press the buy sell. If you want, the first one is the buyer of buy puts or buy call. For the short selling is used for short put and short call. Just remember that. So here is a buy call examples. You press it, you can pick limit orders, then you allow the trades, and yeah, basically then you are done. So this is a recap of the 4 main strategies in option trading. I hope you all learned something here today or get a refreshment about option trading knowledge I have shared for the past few weeks. I hope this won't overwhelm you all, and if some people told me that options can be very complicated, yes, and maybe you all can start with the basic one like a long put and also long call. Then slowly you understand how to trade using this, then you can develop into doing the sell side strategies. So don't be afraid to try, and any questions maybe you all can consider to contact me. And for the left side, please consider to use my referral invitation code of uSMART HK app, Hong Kong apps. The mid one will be the uSMART Singapore apps, and the right side will be my WeCom. If you want to hit me, maybe you can use WeChat to add this. And any questions, you all just leave it down, and I hope I can answer you all and have a good discussion with you all. All right. Okay, I think so. This is my Telegram group. Basically, I think this currently still not active. It depends on the people's. If not people, maybe I will share more ideas or knowledge there. So please consider to add it. And yeah, I think that's for all today. I hope you all learned something today, and I thanks you all for still spending some time to listen to my these sharing sessions. Okay. And lastly, this is the risk disclosure and disclaimer.